Today, we're going to talk about Chapter 7. Some of the main objectives for this chapter are the following. So, the first one is we want to identify the different features of corporate and government bonds, and that just means, how are we going to describe the bonds in terms of the coupon rates, the time to maturity, the yield to maturity, things like that. And then we're going to discuss how we could find the price of a bond, how those prices are determined in the market, and what the relationship is between interest rates and bond prices, and how a bond's price changes over time as it gets close to its maturity or its ending date. And then we are also going to calculate a bond's yield to maturity, and that's just like solving for I on your financial calculator. We'll solve for the yield to call if we have a callable bond. We'll talk about that later. We'll explain the different types of risks that bond investors and issuers face and talk about how a bond's terms and the collateral can be changed to affect its interest rate. So, in general, what is a bond? Well, it's not like a treasury bill. It's a long-term debt instrument where a company like AT&T or ExxonMobil needs money to fund its projects. So they say that they need to issue a bond, which means that they borrow and they agree to make payments of principal and interest on certain dates to the people who invest in the bond. So I could maybe invest $1,000 of my money in an ExxonMobil bond that pays 5% interest semi-annually. And it's for 10 years. What that would mean is every 6 months for 10 years, I would get a 5% coupon rate. 5% is always stated as a percentage of par value. So it would be 5% times 1,000 or $50. And since it's semi-annual, we would divide the 50 by 2. So it'd be $25 every 6 months for 10 years. And then at the end of 10 years, I would get my $1,000 back. So hopefully, over that time, the company has made good investments. The company we're talking about here is ExxonMobil. They made good investments over time so that they're still in business in 10 years and they can pay me my $1,000 back that I loaned them. And so one of the general ideas is just that companies can raise money for their projects that they need to invest in by either issuing bonds, issuing stock, or just by relying on the cash that they generate by their business. But most companies have to have stocks and bonds, and then they rely on their cash too. Where are bonds traded? How do you get access to purchasing a bond? Well, if I'll mention first that if you have a Scottrade account, you can go into their bond market sector and invest, smaller sums of money like $1,000 or $5,000 into companies that need money. And you can look at their different characteristics, like what's their bond rating. That tells you about how safe or how risky your investment is. So you can do that, but most of the trading, like the big time trading where all of the large money flow occurs, is in the over-the-counter market, also called the OTC market. These are just people sitting in different cities across the United States that are calling each other back and forth, talking to the companies, talking to the large institutional investors, and setting up agreements with them. An institutional investor may provide money to loan to a company, or maybe like the company, like Unum, they need to borrow money, and so they work with this over-the-counter broker to let them find a match for people who can fund this type of debt issuance that they need. And then a company like Unum even can invest in bonds of other companies. That's actually a lot of what they do is they're investing in other bonds. And so they deal with their own over-the-counter dealers. This isn't like the New York Stock Exchange, where everybody's in this one building and running back and forth. This is more just calm and people sitting at desks in different cities in the United States. Now, there is a portion of the bond market that is traded on the New York Stock Exchange. So, just so you know that that does exist. For bonds, you can look in the Wall Street Journal and see what the current rates are for corporate bonds, for treasury bonds and treasury bills, and then even municipal markets. Those are bonds issued by state and local governments.